These are the three key elements of a prudent investment. I call it in my new book, the laser test, LSR. Liquidity, safety, rate of return. In other words, if I had an investment for your consideration, you're going to ask me, hey, can I get my money back when I want it back? Number two, is it guaranteed or insured? And then you'll ask, what rate of return can I get? We're all willing to give up a little bit of safety to have a greater rate of return, even if we put our money in the bank. Okay, you ready? I have an investment for your consideration. How much would you invest? You determine the amount and length of time for the monthly contributions to continue. Is that okay? Well, you can pay more than the minimum monthly contribution, but not less. Is that still okay? If you attempt to pay less, the financial institution keeps all of the previous contributions. The money deposited in the account is not safe from loss of principal. In fact, each contribution you make to this account results in less safety. The money in the account is not liquid if you need to get to it. It earns a 0% rate of return. Your income tax liability increases with every single contribution you make, and when the plan is fully funded, there is no income paid out. How many of you feel that that would be deemed as a prudent investment? How many of you are making this investment? What is it? It is a house with a traditional amortized mortgage. In Epiphanies, let me ask you a question. If you buy a house here in Southern California for $800,000 and you take out a mortgage of $600,000, and then you pay down that mortgage from $600,000 down to $400,000. In the meantime, the house goes up in value to $1 million. Who is safer, you or the mortgage company? The mortgage company. They have $1 million asset with only a $400,000 liability there. And who's proportionally less safe? You. If I take a $100 bill out of my money clip and I bury it hypothetically in this tin can in my backyard, is this $100 bill buried in the tin can in my backyard liquid? Yeah, as long as I can remember where I buried it, okay? Is it safe? As long as my dog doesn't know where I buried it, okay? Is it earning a rate of return? No, in fact, it's probably doing what? Yeah, it's probably depreciating. Even with a small amount of inflation, it's losing value. What is the difference between this $100 bill buried in the tin can in my backyard and the hundreds and thousands of dollars we tie up in the bricks, mortar, wooden foundation of our houses? This is more liquid and safe than the money in the house and the property. Everybody got it? Okay. The three key elements: liquidity, safety, rate of return. Let's talk about liquidity for a second. Let's say that you were 2 years ago in New Orleans during Hurricane Katrina. You're relocated to Baton Rouge or Houston, Texas, and you're waiting anxiously to find out when you can go back home. And all of a sudden, you're watching the news and the levee breaks and the floodwaters go up to your roof line. At that moment, do you wish your house was paid off? Or do you wish you had a mortgage on your house and the equity removed in a position where with an electronic funds transfer or a phone call, you could access $50,000 or $100,000 or $150,000? Let's go to Port Arthur, Texas after Hurricane Rita. The mayor of Port Arthur, Texas lost his house in a fire. MSNBC walked up to the mayor and said, "Sir, how does it feel losing your house in fire the day after the hurricane?" Do you know what he said in the emotion of the moment? "The sad thing is, we just paid it off." Did he say the glad thing is he just paid it off? No, the sad thing is. I don't care if you're talking about fires in San Diego like you had a few years ago, mudslides in Laguna Hills, tornadoes in Kansas, or hurricanes in Florida. I sleep better at night with my home equity removed in a position of liquidity. I learned this lesson the hard way, as I explained at the beginning. If you were invested in the stock market back in 1987, and I'm your investment consultant. In September, I tell you to get out of the market and convert to cash. I would have been a hero, right? What happened in October? Crash. Okay, let's fast forward. And if you would have just had liquidity for 90 days, you came out okay. Let's fast forward to 2000, 2001, 2002. If you didn't have 2 or 3 years of liquidity and you sold or you got scared and sold, most people in the market lost 30%. Liquidity is number one. I keep my equity separated to stay liquid. Number 2 is for safety of principal. I learned that lesson the hard way. As I told you, no matter what happens, if a house goes up in value or down in value. Sometimes people, the last couple of years here in Southern California, when I told them, you got to separate your equity, they said, well, golly, I have a 3-bedroom, 1,200 square foot house in Newport Beach that's worth $1 million. And you're telling me to separate my equity? What if that real estate bubble bursts and my house goes down from $1 million down to $800,000? I said, I guarantee if you leave your equity in your house and it goes down from $1 million to $800,000, you will lose $200,000. You need to separate your equity when the house is worth this. Then when it goes down in value, you're still in control. I can still peel off dollars and make the mortgage payment. But whether the house goes down or up in value, you need to stay in control, as I'm going to show you.